Namaskar and welcome to Sansad Television. I am Vishal Dahiya and you're watching our special show Perspective, where we bring you detailed analysis of all key national and international issues. Today we're going to talk about Reserve Bank of India's monetary policy review. Now, based on an assessment of the evolving macroeconomic and financial conditions and the outlook, RBI's Monetary Policy Committee has decided to maintain status quo with regard to the policy repo rate and retain the accommodative policy stance. While the policy repo rate under the Liquidity Adjustment Facility, that is LAF, remains unchanged at 4%, the reverse repo rate under the LAF will also remain at 3.35%, along with the marginal standing facility rate and the bank rate at 4.25%. The MPC also decided to continue with the accommodative stance as long as necessary to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target going. Now, the MPC noted that economic activity over the past 2 months has broadly evolved in consonance with the MPC's August assessment and outlook, and CPI inflation during July to August has turned out to be lower than anticipated. Now, the central bank has kept CPI inflation projections for 2021-22 at 5.3%. The projections for the real GDP growth has been kept at 9.5% in 2021-22. In this episode of Perspective, we will discuss and analyze all aspects of these decisions taken by RBI's MPC and will understand their overall impact as well. And for more on this, we're joined by three distinguished experts. Let me first introduce them to you. Beginning with, we have with us Professor Aman Agarwal here in the studio. He is Director, Indian Institute of Finance. We're also joined by Mr. Nilesh Shah, part-time member of Economic Advisory Council, Prime Minister's EAC, and Shubhmoy Bhattacharya, consulting editor, The Business Standard, is also joining us. Welcome, all of you gentlemen, to Sansad Television. Let me begin with you, Mr. Shah, and let's start by, understanding, number crunching also. This is, once again, the RBI has kept the rates unchanged. That's one very significant move. We'll have to understand why and how of it, and also the short-term and long-term impact of this decision.
Essentially, this policy is "Main Hoon Na" policy of RBI. There are many multiple conflicting factors which are shaping economy today. On one side, we are sitting on $120 billion of excess liquidity, and it looks like that with strong foreign direct investment, this liquidity will keep on rising. RBI reassures market that I will manage the liquidity by extending BRRR's tenure. I will absorb this liquidity. On the other hand, there is a borrowing program of the government. Despite recent buoyancy in tax collection, it's a very large borrowing program. And that has changed yield curve or interest rates. RBI again here has reassured market that we will do open market operations, we will do operation twist, and I have to stop GSAP because there is so much of excess liquidity. But don't worry, I will keep rates range bound.
Okay.
The third thing was related to inflation. We have seen commodity prices going through around the world, be it energy prices, be it food grain prices. And again here, RBI has reassured the markets that we will carefully watch inflation and we will ensure that inflation doesn't go out of control. The final thing is financial market stability. I mean, clearly, availability of credit and smooth functioning of market are absolutely vital for economic growth. Here, RBI has steered Indian economy in last 18 months through all the ups and downs of COVID-19 with remarkable success.
Okay.
So in a sense, this is "Main Hoon Na" policy where RBI reassures economy, market participants that we will manage growth, we will contain inflation, we will absorb liquidity, we will keep financial market liquid and stable, and overall, we will be supportive of growth.
Okay. Okay. Shubhmoy, do you agree there that this is a sort of a reassurance signal coming in from the central bank to the markets, to the industry, to the government as well, that yes, we're there and we're going to support it till the time this crisis blows over?
Absolutely. I like the way Nilesh put it, Mehuna policy from RBI, and I think that's exactly what the markets needed, which is why both the bonds and the stock markets reacted, showing essentially that they've liked what they heard from the governor. And that was so. A, it was necessary. B, as you would notice, the governor's accent was not on changing rates. It was not even expected. The assessment, every estimate had said the rates will not be changed. What he has changed, and very smartly at that, is the expectation of liquidity. He has, Nilesh was pointing it out, that the liquidity overhang in the market, RBI is saying that we are going to look at it and we are taking steps to ensure that there is not that amount of free cash going around. This is important because RBI thinks that that's necessary to keep the inflation under control. The inflation expectations for this year, RBI is saying we expect it to be with less than 6%, somewhere around 5.3. So that means that, and that obviously cannot happen if there's excess liquidity in the market. Because if there's too much money chasing too much of goods, then obviously there's going to be inflation. So RBI is basically sucking out liquidity that is not required from the market.
Professor Agarwal, reassuring stance as both the experts are pointing out, and ensuring that there's a check on the liquidity flow as well as per the requirements. What's your assessment of the MPC's decision to maintain the status quo and also adopt an accommodative posture here?
No, I think it's a very good stance which has been taken, and very much along the lines, more behaving like a mature central bank, which RBI is to a great extent, but still it's an emerging country like India we are, and there are volatile factors, volatility which is there in various markets, which does make the central bank wonder at times. Although he did talk about the way central banks are crunched today around the world, some trying to flush in more money, some trying to create or control more money. And fortunately, from that perspective, India has been doing very well. And this is what he tried to point out, giving a global perspective and India's perspective. He also pointed out very clearly that despite the liquidity concerns and the liquidity which is there, he has tried to keep it under tab. And the fact that the inflation has eased out was only a temporal manner where we saw a couple of months back when the inflation peaked up. And he feels that it's going to settle in. And that's why he gave projections for all the 4 quarters, which are again unchanged. He also gave the projection for the growth rate at 9.5%, which is also consistent with what they had done before. And he also said in Q1, the projections of the growth rate of 20% was almost close to what they had projected before.
Yeah, that projection was somewhere around 21%.
Correct. So they are almost very close to what they are actually doing. So talking about the fact that the kind of calibrations the central bank is giving out is coming very much in tune. And I think this is a very important message which comes out of the central bank and the governor, not only to the Indian market, but to the global market, given the fact that we are the reservoirs of largest foreign direct investment, foreign institutional investment coming to India last year, specifically when COVID was there and the large part of the world was under deep waters and had no money to plunge, but we still received roughly about $73 to $74 billion, coming to $6.5 billion a month.
Indeed.
And about $35 billion in portfolio, which is the largest in the last 7 years. Now, this is at a time when the world is not having the money, economies are not having the money, institutions are not having the money, and India is receiving such measures. And as a result, we also saw the Moody's rating recently. So these are very much in collaboration, and this gives a very positive signal to the world market, not only in the banking sector, but even otherwise.
Okay. And that also shows how strong the economy
and the country is.
Yes. Mr. Shah, I'd like to bring you in here on these 2 aspects which Professor Agarwal has pointed out. One is the projections vis-a-vis the growth. And the second is inflation. Now, the key question here is obviously, up till August, the inflation has been under check, and the calibrations and calculations of the central bank seems to be right on the spot there. But when we look a little deeper into the future and looking at it for the next 2 or 3 quarters, what is your assessment vis-a-vis inflation? Because that's going to be a very, very important factor.
So normally between end of monsoon season and beginning of Rabi crop, there are always spikes in vegetable prices. So will we see a month or 2 where increase in potato, onion and tomato prices kind of impact headline inflation? Answer is yes. But subject to that increase, the big figure for inflation is likely to remain around 5% for rest of this year, that is calendar year 2021. Almost 50% of our CPI inflation comes from food, and that is linked to minimum support prices. And fortunately there, because of good monsoon and also adequate stocks, food grain prices will remain under control. About 10% inflation comes from housing side, which is more linked to HR allowance of the employees rather than real housing yield. That also should remain moderate. And about 15% comes from the fuel side. Now here RBI governor did mention that through calibrated adjustment on the tax burden on fuel prices, fuel inflation can be managed. I believe that's potentially an indicator towards some sort of reduction in taxation burden on fuel prices. So about 75% of our inflation is likely to remain moderate, and 25% will be impacted by energy prices or by commodity prices. But overall, inflation subject to potato, onion, and tomato will remain around 5% handle for rest of the year.
Okay, so that seems to be sort of a positive outlook there. Shubhmoy, your views there on these two issues, the projections vis-a-vis growth and more importantly, inflation there. Shubhmoy, you will have to unmute yourself.
You know what, currently the problem is that inflation, we already talked about liquidity-driven inflation. The other thing is we are also having to import inflation from abroad, both for oil, for gas, and now for coal. And these have the potential of destabilizing the inflation numbers. So how it will pan out will, of course, depend also on the fact that at the other side, the economy is also going up. So it's not just inflation that is rising, production is also rising. So it would definitely have a balancing impact on inflation if the production rises fast. The point is that inflation expectations, once it gets into the economy, becomes a difficult situation for a monetary authority. Which is why the RBI governor has been very keen to say that I will control inflation. And in fact, that is their primary focus, along with growth, that they have to monitor inflation. So it's good that they are already taking steps to stamp out inflationary expectations in the economy. And I think that will be something that we shall have to be very, very watchful given going forward.
Okay. Professor Agarwal, I'd like to bring that back to you. You referred to that projections vis-a-vis both inflation and growth. But when we are trying to do a forward outlook here vis-a-vis inflation specifically, do you agree with what both Mr. Shah and Shubhmoy are pointing out, that yes, there might be a bit of an impact, but it will be balanced out in the midterm there?
No, I think the RBI in the last year and a half has clearly shown how well it can manage both the inflation and growth and keep it stable. However, the RBI governor a couple of months back also and now also has given a signal that there is an overburden on inflation getting risen up because of the oil prices. Now, this is something certainly a matter of concern because it has a rebounding impact which can be there. And you see, not all, although Sukhmay mentioned of imported inflation from overseas, but not oil, because the oil which we get is mostly contracted prices. These are not changing every day that we are buying the oil from the petrol pumps like you and I buy, is the way a country buys an oil. The oil which comes into our cars today is something which has been actually bought and processed 3 or 4 months back. So there is no question of that volatility coming up. And secondly, the oil pool account created by the government way back when N.D. Tiwari was the finance minister way back in 1891, has this tax revenue which has been collected and part of which is expected to be used for the vaccination purposes. But then apart from that, it is still there. So the government does have that bound and can actually go about reducing and easing of that pressure, because in the long run, this pressure is not good. Till now, it was good because we were all in a deflationary pressure last year, and that was, we need that rebounding factor which was there. We need that push which was there, and we have got that push. But if it sustains itself for a long time, and this is where the government needs to think, and I think our finance minister has actually talked about the GST in the last GST meeting, and I hope in the subsequent meetings some kind of a concrete decision can take place on this front. And if that does, I think the RBI's governors worry of actually even looking at that inflation figure as of today would diminish off completely. And I hope, I'm very hopeful with the government's positive stance, the reform framework which they've introduced since 2014, the Atmanirbhar program, the other policy programs they've done, I think they would certainly would want it to be as part of the GST and ease off and give a relief to the common man and even the RBI governor in terms of managing its monetary policy.
Okay, now let's take that to Mr. Shah here, who is on Prime Minister's Economic Advisory Council. Mr. Shah, vis-a-vis, when we are looking at the intertwining of government's policy decisions or reform measures and the RBI's accommodative stance here, keeping in check inflation is obviously one part of it, but overall, both central bank and the government will have to walk shoulder to shoulder with each other to ensure that the economic recovery is on the path, and we maintain that growth figures as well.
So my best metaphor for RBI is that they are running the, chariot of Bharat, just like Krishna Bhagavan was running Mahabharat's chariot. And fortunately for Krishna Bhagavan, all the horses were in one direction. But unfortunately for RBI, they have different horses in different directions. They are responsible for growth, but they are also responsible for containing inflation.
Okay.
They are responsible for government's borrowing program, but they also have to keep interest rates under control so that growth does not suffer. They are also responsible for rupee, and they have to ensure that rupee does not depreciate significantly. Now, these are all very, very complex, multiple objectives. To support growth, you have to cut interest rates that can depreciate rupee. To push government's borrowing program, you want least possible borrowing cost. But if you keep interest rates too low, inflation can rise.
Indeed.
RBI, as a very, very skillful charioteer, manages these multiple objectives. Unlike in Western world, where ECB was managing just about inflation, or US Fed, which is managing employment and inflation, RBI manages multiple objectives. And to the extent RBI and government works together, they move in same direction. Indian economy will continue to get supported.
Okay. Shubhmoy, your views there on the policy reforms which are already underway, more which are expected, and given the fact that we are in a post-pandemic situation where the economy is on a recovery path, RBI has once again, adopted an accommodative stance. How do you think both RBI stance and government's policies, need to get intertwined from here onwards as well? Till the time it looks like both of them are working fine in tandem with each other. From here onwards also, it will remain very crucial.
Absolutely, Vishal. And, right now, in fact, the Krishna simile is rather appropriate. What RBI is doing is it is sort of holding the storm back. And it's giving the fiscal policy the space to play out. And the time is short. The time is short. It's just about this quarter and a bit of next quarter, within which all the fiscal reforms will have to be done. It's good that in this context, government has announced Air India disinvestment. That's one of the solid things that you need to sort of perk up people's idea that yes, reforms are here as a very major issue. So that is the sort of playing together that will have to be done, because RBI is basically ensuring that the spillover from liquidity does not come over into the market to create inflationary pressures. But it is only that much that it can do, unless, and the time will run out, unless the government's reform measures, they've already done a lot, as you've said. But all the stuff which needs to be done very fast.
Okay.
Because there won't be time because otherwise you really won't have the time before the flood of inflation actually comes in. And by that time, these things will have to already be in place. So, yeah.
Okay, okay. Professor Agarwal, what are the key areas? You mentioned one of them, obviously, and that is for the GST Council to go ahead and take a decision on whether or not to bring the petroleum products under the GST's ambit. But apart from that, when we are looking at, the big reforms push or the reforms agenda of Prime Minister Modi's government and it being in sync with what the RBI stance has been, and as, Mr. Shah was pointing out, it's a very complicated task.
No, it certainly is, but I think Shaktikant is doing an excellent job in terms of managing that balance and taking the car forward. And I think that's very good because, he also talked about certain interesting things about the NBFCs, the digital payment framework, even retail payment gateway in terms of offline mode, and extending the IMPS framework, which is in tune with the digital policy framework, which we have seen major announcements, even Prime Minister coming and inaugurating some of them in terms of going forward. And I think that has put a lot of things in perspective in terms of growth of the stock markets, in terms of the growth of the economy. Even the tax revenue payments, which we see have gone up this last 2-3 months, is primarily, majorly a contribution of the online platform payments, which are getting utilized extensively. And that has been given due leverage in Part B of his speech today as well.
Indeed.
So I think that is something which is critical, that clearly shows that there is a beautiful sync between the government and the RBI, not looking at the government as all yes, yes, but taking an objective view and seeing what is the right balance, where they need to say yes to the government and where they need to hold on and see the public interest, the people interest in large. What, in my opinion, is the last thing which RBI's mandate is not there, but the government says that this GDP growth, which we are looking at 9.5%, must be felt by the commoners of the commoner people in this country. And that is where the government roles comes in. And to deliver that, the government is doing its bit. And I think the vaccination drive is one of the biggest drives in terms of trying to push that forward and the confidence being rebuilt. But still, the government will need to do more along the lines with the RBI is doing.
Okay, indeed. And, battling this pandemic is one very big task, which both the policymakers at the government and RBI also need to factor in. Quick concluding comment from you, Mr. Shah, since, Professor Agarwal brought this to the fore. That's the push to the digital economy part. And that seems to be on the mind of RBI governor as well, RBI's, a policy think tank also.
Undoubtedly, the world is going to add far more value through digital adoption than physical adoption in the years to come. And over here, India has taken a different path. For us, Aadhaar, RuPay, Bheem, UPI, etc. are all on public platform. They are available to anyone for free. There is no monopoly. Whereas the same thing in many other developed markets is private monopoly. And which is where we will be able to create a decentralized network effect, where without monopolizing of few, we will be able to adopt digital systems across our entire spectrum. This may not be the case in Western world. And very recently, we saw when a monopoly service provider gets disrupted, the whole world can come to an end. That will not happen in India. And RBI is encouraging fintechs and digital adoption in banking and NBFC system. And that adoption through RuPay, through Aadhaar, through Bheem, through UPI, through IMPMS kind of things will make a material positive impact.
Okay, indeed, there it is. Thank you so much, Mr. Nilesh Shah, Shubhmoy, as well as Professor Aman Agarwal for sharing your views and insight with us and our viewers, as our experts have pointed out and made us understand the importance of RBI, maintaining a status quo vis-a-vis the monetary policy. It is a complex and a complicated process, but then the central bank seems to be on the job there, maintaining the status quo vis-a-vis the rates and also giving a push to the digital part of their economy there. We'll come back again tomorrow with a different topic. Till then, keep watching Sansad Television. Thank you.